The screen is almost completely black. There is no music, only the faint sound of paper moving across a desk. A man sits alone in a small room. Outside, a city is beginning another ordinary morning. People are buying breakfast. Taxis are moving through traffic. Shopkeepers are opening their doors. Millions of people are going to work. And yet, somewhere inside that city, something has already changed. The money people earned yesterday is worth slightly less today. Not enough for anyone to notice. Not enough to cause panic. Not enough to make the evening news. But it is happening. Slowly, quietly, almost invisibly. A central bank creates new money. Commercial banks create new credit. Governments borrow. Prices adjust. And eventually, the ordinary person notices. The grocery bill is higher. The rent is higher. The house is farther out of reach. The retirement target moves further away. So the person works harder, saves more, invests more aggressively, takes more risk, and sometimes wonders why getting ahead feels strangely difficult. Now imagine something even more disturbing. Imagine a form of money that nobody can simply print because they need more of it. No president controls it. No central banker sets its supply. No company owns the network. No country can switch it off with a meeting. It exists on thousands of computers around the world. And its creator disappeared. Not metaphorically, actually disappeared. The creator used a pseudonym. Then, after launching the system, vanished from public view. But before disappearing, that mysterious creator left behind a message buried inside the very first block of the network. It referred to a newspaper headline from January 3rd, 2009. Chancellor on brink of second bailout for banks. It was the middle of the global financial crisis. Banks were collapsing. Governments were rescuing financial institutions. And somewhere in the chaos, an unknown programmer quietly created Bitcoin. The first block was mined on January 3rd, 2009. At the time, almost nobody cared. There were no television crews, no Wall Street executives, no billion-dollar investment funds, no national governments. Just software, a network, and an idea. But the really strange part came later, because Bitcoin wasn't merely an invention of computer science. It was an argument about money, what money should be, who should control it, and perhaps, most importantly, what happens to society when people stop trusting the money they use. That is where Saifedean Ammous enters the story. In 2018, Ammous published The Bitcoin Standard, the decentralized alternative to central banking. The book became one of the most widely read introductions to Bitcoin and helped push the idea of sound money into mainstream Bitcoin discussions. But Ammous did something unusual. He didn't begin with Bitcoin, he went backwards, thousands of years backwards. Because if you want to understand Bitcoin, he argued, you first need to understand something humans have been struggling with for thousands of years: money. And the story of money is much stranger than most people realize. For most of human history, people didn't have bank accounts. There were no credit cards, no ATMs, no digital payments, no Federal Reserve, no dollars, no euros, no Bitcoin. There were just people trying to trade. And trading sounds simple until you actually try it. Imagine you have chickens. Your neighbor has wheat. You want wheat. Your neighbor wants chickens. Perfect. You trade. But what if your neighbor doesn't want chickens? Now you have a problem. Maybe he wants shoes. The shoemaker wants wheat. The farmer wants chickens. Suddenly, a simple exchange becomes a puzzle. Economists call this the double coincidence of wants. Humans solved this problem by searching for something everyone would accept. Something durable, portable, divisible, recognizable, and difficult to produce. Over centuries, different societies experimented with shells, cattle, salt, beads, metals, and countless other objects. Eventually, precious metals became especially powerful. Gold was rare. It didn't rot. It didn't rust easily. It could be divided. It could be carried. And crucially, producing more of it was difficult. That last property mattered enormously, because money has a strange psychological effect. If something is difficult to obtain, people tend to treat it differently. They save it. They protect it. They think carefully before spending it. But if something can be produced almost effortlessly, behavior changes. A person spends differently when money feels scarce, and differently when money feels abundant. This is where Ammous introduces one of the central concepts behind his argument: sound money. The phrase sounds technical. The idea isn't. Sound money is money that is difficult to produce in unlimited quantities. Think about it like a bridge. A strong bridge needs constraints. There are limits on how much weight it can carry. Remove every constraint and eventually the bridge collapses. Money can have a similar problem. If the supply can expand without meaningful limits, the purchasing power of existing money can be diluted. But this is where the story becomes controversial, because governments and central banks don't create money simply because they enjoy printing pieces of paper. Modern economies are enormously complicated. During financial crises, policymakers often argue that expanding the money supply can prevent economic collapse, and sometimes those interventions can help stabilize the system. This matters because the Bitcoin standard is not the only way to interpret monetary history. Economists disagree sharply about the gold standard, central banking, inflation, debt, and Bitcoin. Some of Ammous' historical interpretations have also been criticized by economists and central bank reviewers. So this documentary isn't about asking you to worship Bitcoin. It is about understanding the deeper question: why does money need rules at all? To answer that, we have to travel back to one of the most important monetary experiments in modern history: gold. For centuries, gold played a special role in international commerce. But by the 20th century, the world had built something more complicated. After World War II, dozens of countries created the Bretton Woods system. The dollar became the central reserve currency, and the dollar was convertible into gold for foreign governments at a fixed rate. For a while, the arrangement appeared stable. But stability has a price. Governments needed to maintain confidence in the system, and the United States was spending enormous amounts of money. Then came the Vietnam War, domestic spending, growing international dollar holdings, and increasing pressure on American gold reserves. Foreign governments began asking an uncomfortable question: if we hold dollars, can we really exchange them for gold? Eventually, the answer became impossible to sustain. On August 15, 1971, President Richard Nixon announced that the United States would suspend the dollar's convertibility into gold. The decision became known as the Nixon shock and effectively ended the Bretton Woods monetary arrangement. It was presented as a response to an economic emergency, but something much bigger had happened. For the first time in the modern era, the world's dominant currency no longer needed to represent a fixed quantity of a physical monetary asset. Money became increasingly based on trust. Trust in governments, trust in central banks, trust in institutions, trust that tomorrow's dollar would still have value, and trust is powerful until it isn't. This is one of the deepest ideas running through Ammous' book. Money isn't merely a tool for buying things. Money is a system of coordination. It allows strangers to cooperate. It allows workers to save today's labor for tomorrow. It allows businesses to plan. It allows families to transfer wealth across generations. In other words, money stores human effort. You work today. You receive money. You don't consume everything immediately. You save. That saving represents time you have already sacrificed. And that creates a profound psychological connection. When inflation rises faster than expected, the damage isn't only mathematical, it can feel personal. You worked for those dollars, you traded hours of your life for them. If their purchasing power declines, part of the value of your stored effort disappears. This is why inflation can be emotionally confusing. You don't see money being taken from your wallet. Your bank balance might look exactly the same. You still have $10,000, but what that $10,000 can buy has changed. The number stayed, the purchasing power moved. And humans are notoriously bad at understanding gradual losses. Behavioral economists have spent decades studying this. We tend to react more strongly to visible losses than invisible ones. Losing $100 from your account hurts immediately. Losing purchasing power slowly over years can barely register. That difference matters, because financial systems often operate on time scales longer than human emotions. A person thinks about this month's paycheck. A monetary system operates for decades. A government thinks about the next election. A family thinks about the next generation. A central bank thinks about inflation, employment, financial stability, and economic growth. And Bitcoin asks an uncomfortable question. What if some of the rules surrounding money should not depend on human discretion at all? That question became especially powerful after 2008. The financial crisis had shattered confidence in major institutions. Lehman Brothers collapsed. Credit markets froze. Governments intervened. Central banks responded with extraordinary measures. The global financial system survived, but millions of people watched something unsettling. Some institutions had made enormous mistakes, and when the system was threatened, governments had the ability to create and deploy enormous amounts of money to prevent a larger collapse. Whether one believes those interventions were necessary or harmful, one fact was undeniable. Money was not neutral, it was governed. And whoever governs money possesses extraordinary power. Then, in January 2009, Bitcoin appeared. Not inside a government building, not on Wall Street, not backed by a central bank. It began as an open-source network. Anyone could download the software, anyone could verify the rules, anyone could participate, and nobody needed permission from a bank to join. That was revolutionary. But there was a problem. A digital object can be copied, a photograph can be copied, a song can be copied, a document can be copied. So how do you create digital money that cannot simply be copied and spent twice? That was one of the great problems of digital cash. For decades, cryptographers had tried to solve it. Some projects came close. None achieved the combination of decentralization, security, and scarcity that Bitcoin eventually demonstrated at scale. Satoshi's breakthrough wasn't creating digital information. It was creating digital scarcity. The network could keep a shared record of ownership without relying on one central institution. Thousands of computers could independently verify the rules, and the supply schedule was built into the protocol. There would never be more than 21 million Bitcoin. That number became one of the most famous monetary constraints in the world. But scarcity alone doesn't make something valuable. Diamonds are scarce. So are paintings. So are rare baseball cards. Scarcity only matters when people want the thing, and that leads to the most dangerous part of the Bitcoin story, because Bitcoin needed something much harder to manufacture than coins. It needed belief, not blind belief, network belief. The belief that other people would continue recognizing the same rules, that miners would continue securing the network, that users would continue holding and transacting, that developers would maintain the software, that the system would survive attacks, that governments wouldn't simply destroy it, and most importantly, that tomorrow's Bitcoin would still be Bitcoin. This is where money becomes psychology. A dollar works partly because you expect someone else to accept it. Gold works because humans have valued it across civilizations. Bitcoin works because a growing network agrees on a set of rules and verifies them without a central authority. Every monetary system ultimately depends on coordination. The difference is where that coordination comes from, and this is the hidden battle underneath the Bitcoin standard. It isn't simply Bitcoin versus dollars. It is discretion versus rules, human judgment versus predetermined constraints, trust in institutions versus verification through a network. And once you see the argument that way, the book becomes much bigger than cryptocurrency, because the question isn't really, will Bitcoin go up? The deeper question is, what kind of money encourages people to think about the future? That question leads directly into one of the most important ideas in Ammous's worldview. Time preference. Imagine two people receive $1,000. Person A spends everything tonight. Person B invests or saves it for 10 years. Neither person is automatically smarter, but they are making different choices about time. Person A values the present more heavily. Person B places greater value on the future. Economists call this time preference, and civilization depends heavily on people being willing to delay gratification. Why? Because almost everything valuable takes time. A child takes years to educate. A company takes years to build. A factory takes years to pay for itself. Scientific research can take decades. Infrastructure can take generations. Even personal wealth works the same way. You earn, you save, you invest, you wait. Then compounding begins doing something almost magical. A return earns another return, then another, then another. At first, almost nothing seems to happen. This is why compounding is psychologically difficult. The early years feel boring. The later years feel extraordinary. But the later years only exist because someone survived the boring years. This is true for money. It is true for businesses. It is true for skills. And it is true for Bitcoin itself. In its earliest years, Bitcoin looked ridiculous. There was no mature market, no institutional custody, no exchange infrastructure like today. Very few people understood it. A strange internet currency created by an anonymous person. It sounded like a science fiction experiment, and yet people kept building. Then something unexpected happened. People started assigning it a price, then a market, then exchanges, then businesses, then entire industries, and eventually some of the world's most sophisticated investors began taking it seriously. But the journey was anything but smooth. Bitcoin repeatedly crashed. Its price fell dramatically many times. People declared it dead. Then it returned. Again and again. This created a psychological phenomenon that few investors were prepared for. The asset was not merely volatile. It was emotionally violent. And that exposed a timeless weakness in human behavior. People say they want extraordinary returns, but when extraordinary returns become possible, they often arrive with extraordinary uncertainty. Most people don't actually fear volatility. They fear uncertainty. And Bitcoin offered both in enormous quantities. That is why its history became a laboratory for investor psychology. Greed at the top, fear at the bottom, confirmation bias everywhere, people searching for information that supported what they already believed. Bitcoin believers saw evidence of monetary revolution. Bitcoin critics saw evidence of a speculative bubble. Both sides could find endless material online, and the market kept moving. But beneath all the price charts was a much older human story, the story of people trying to preserve the fruits of their labor, the story of societies deciding what counts as money, the story of governments discovering how much power money can provide. and the story of ordinary people discovering that the thing they trusted most might not be as permanent as they thought. Saifedean Ammous grew up in Lebanon during years shaped by civil conflict and economic instability, an experience he has connected to his later interest in money and monetary systems. He went on to study mechanical engineering, development management, and economics-related subjects before becoming an economics professor and later an author and educator. His personal journey matters because it helps explain the intensity of the book. For someone who grows up believing that money is simply money, monetary policy can feel abstract. For someone who watches currencies, banks, and institutions behave unpredictably, money can feel existential. Ammous eventually became deeply influenced by Austrian economics, a tradition that emphasizes individual choice, market processes, and the role of money in coordinating economic activity. Then he encountered Bitcoin, and instead of asking only how the technology worked, he asked a different question: why would humans need it? The answer led him through thousands of years of monetary history, from shells to silver, to gold, to paper, to central banking, to fiat currencies, and finally, to a digital asset that was born during the wreckage of the 2008 financial crisis. But there was one historical lesson that made the Bitcoin argument far more dangerous than it first appeared. Because if money shapes behavior, and money shapes time preference, then changing the nature of money could change something much deeper. It could change how people save, how they invest, how businesses think, how governments borrow, how societies plan for the future. And suddenly Bitcoin wasn't just a new kind of money, it was potentially a new kind of incentive system. And incentives are where human history gets interesting, because people rarely behave according to what they say they value. They behave according to what the system rewards. And that is where the story takes us next. You save part of it, then prices rise, so you need to save more. Then prices rise again. Now you need even more. Eventually the pressure becomes psychological. Why save? Why wait? Why hold cash when tomorrow it buys less? Spend it, invest it, borrow, buy the house, buy the car, take the trip, do something with it now. This is where monetary policy meets human psychology. A person doesn't need to understand economics to respond to incentives. The system teaches them through experience. And this is one of Ammous' most provocative arguments. A monetary system can influence whether society becomes more focused on the future or more obsessed with the present. This idea is sometimes described as low-time preference. It simply means being willing to sacrifice something today for something more valuable tomorrow. Civilization depends on this behavior. Think about a farmer planting a tree. He spends time preparing the soil. He waters it, he protects it. But he knows something important. He may not enjoy the fruit this year, perhaps not even next year. He is investing in a future he cannot immediately consume. Human civilization is filled with these decisions. Parents educate children they cannot immediately profit from. Entrepreneurs build companies that may take years to become profitable. Scientists conduct research whose benefits may arrive decades later. Investors buy productive assets and wait. Societies build roads, universities, power stations, ports, and factories. Almost everything valuable requires delayed gratification, and this creates a fascinating connection between money and civilization. If people believe their savings will preserve value, waiting becomes easier. If people believe their savings will steadily lose value, waiting becomes harder. But there is an important distinction. Inflation does not automatically destroy saving. People can save through productive assets. They can own businesses, stocks, real estate, bonds, commodities, and other investments. In fact, modern financial markets exist partly because people need ways to preserve and grow wealth beyond simply holding cash. So the real question isn't whether inflation makes saving impossible. It is whether monetary conditions change the incentives surrounding saving. And here the history becomes more complicated, because one of the most powerful investment ideas of the 20th century came from a man who understood incentives better than almost anyone: Warren Buffett. Buffett has repeatedly emphasized the importance of owning productive assets and thinking long-term. He has also criticized Bitcoin because, unlike a productive business, Bitcoin does not generate cash flows, earnings, or dividends. That distinction is crucial. A farm can produce food. A factory can produce goods. A company can generate profits. A rental property can produce income. Bitcoin doesn't produce anything by itself. Its value depends on what someone else is willing to pay for it. That makes Bitcoin fundamentally different from a productive asset. And this is one of the first traps viewers should avoid. Bitcoin isn't magic. It doesn't automatically create wealth. If you buy something for $10,000 and sell it for $20,000, the extra $10,000 came from another buyer's willingness to pay more. That doesn't mean Bitcoin has no value. It means its economic properties are different, and understanding that difference is far more important than predicting its price, because price and value are not the same thing. A stock can be valued based on expected future cash flows. A bond can be valued based on payments. A business can be evaluated through earnings, assets, competition, and growth. Bitcoin requires a different framework. You are essentially asking, how valuable is a scarce, transferable, censorship-resistant digital monetary network? That is a much harder question, and it explains why intelligent people can look at the same Bitcoin and reach completely different conclusions. But the book's historical argument goes deeper. Ammous believes Bitcoin should be compared less with companies and more with monetary goods. Gold becomes the obvious comparison. For thousands of years, gold has served as a form of money or monetary reserve. Its most important characteristic isn't that it is shiny. It is that humans have struggled to create more of it quickly. Suppose the price of gold doubles? You might expect miners to flood the market, but gold production cannot instantly double. Mines take years to develop. Equipment must be built, permits must be obtained, workers hired or extracted, processed, transported. Even if gold becomes much more valuable, production responds slowly. This property is sometimes described using a useful concept: stock to flow. The stock is the amount that already exists. The flow is the amount newly produced. Gold has a large existing stock relative to its annual production. That makes sudden supply increases difficult. Bitcoin was designed around an even more predictable supply schedule. New Bitcoin enters circulation through the mining process, but the issuance rate is programmed to decline over time. Approximately every 4 years, the reward miners receive for producing new blocks is cut in half. This event is known as the halving. The latest halving before the date of this documentary occurred in April 2024, reducing the block subsidy from 6.25 Bitcoin to 3.125 Bitcoin. That does not guarantee a price increase. This is important. Markets don't obey simple formulas, but the supply schedule is remarkably predictable. That predictability is the point. Imagine a gold mine whose annual production schedule was known centuries in advance. Imagine knowing approximately how much new gold would enter circulation next year, and 10 years from now, and decades from now. That is unusual. Bitcoin made scarcity programmable, and that phrase deserves to be remembered. Scarcity became code. But scarcity alone doesn't create a monetary system. The system needs security, and security costs energy. This is where Bitcoin's mining mechanism becomes controversial. Bitcoin uses proof of work. Miners compete using computing power to add blocks to the blockchain. They consume electricity. Critics argue that this is wasteful. Supporters argue that the energy expenditure is precisely what makes the network difficult to attack. The argument is subtle. Bitcoin doesn't make its ledger trustworthy because a powerful institution says it is trustworthy. It makes manipulation expensive, very expensive. To understand why, imagine a scoreboard for a global competition. Thousands of independent observers maintain copies. If someone secretly changes yesterday's score, the rest of the observers reject it. Now imagine that rewriting the history of the competition requires enormous computational work. That is roughly the intuition behind proof of work. The network doesn't ask you to trust one accountant. It asks participants to verify the rules. This is the deeper technological breakthrough, not digital money. Digital money had been attempted many times. Bitcoin combined digital scarcity with decentralized verification, and that changed the problem. But there was another problem. Who controls the network? Nobody. That sounds reassuring, until you think about it. If nobody controls it, who fixes it? Who changes the rules? Who decides what counts as a valid transaction? Who stops fraud? Who decides how many Bitcoins exist? The answer is fascinating. The rules are enforced by thousands of independent participants running software. A miner cannot simply decide that 30 million Bitcoin should exist. A developer cannot magically create coins for themselves. A large company cannot rewrite the ledger just because it wants to. A government cannot simply order the global network to adopt a different monetary policy. But cannot doesn't mean impossible. Bitcoin is not immune to attack. It is not immune to regulation. It is not immune to human mistakes. It is not immune to technological risks. It is simply designed so that changing certain rules requires broad agreement across the network. And this reveals another powerful principle. Bitcoin moves trust away from individuals and toward rules. That doesn't eliminate trust. It changes what you trust. Instead of trusting one institution to maintain the money supply, you trust mathematics, software, incentives, and a distributed network. And that brings us back to 2008. Because the timing of Bitcoin's birth was not random. The world had just experienced a devastating lesson in financial trust. Banks trusted models, investors trusted ratings, homeowners trusted rising property prices, markets trusted liquidity, and governments trusted that extraordinary interventions could prevent systemic collapse. Then the machine broke. The result was not merely financial, it was psychological. Millions of people watched institutions they considered permanent suddenly appear fragile. And when trust disappears, people start asking questions they previously considered unnecessary. Where does money come from? Who creates it? Why does it have value? Why does a bank balance represent money? Why can a central bank expand the monetary base? Why does the government borrow? Why does inflation exist? Why should anyone have the power to alter the rules? Bitcoin arrived in that psychological environment. It was almost as if someone had thrown a match into a room filled with questions. But the most interesting part of Bitcoin's early history wasn't its technology, it was its community. The first users were not traditional investors. They were programmers, cryptographers, cypherpunks, people interested in privacy, digital freedom, and decentralized systems. They weren't necessarily looking for another asset to add to a portfolio. They were experimenting with an idea. Could strangers coordinate without a central authority? That question had enormous philosophical implications. and the idea had appeared before. The cypherpunk movement had spent decades exploring digital privacy and cryptographic communication. Some early pioneers had already proposed forms of electronic cash. David Chaum developed DigiCash. Nick Szabo proposed BitGold. Adam Back created Hashcash. Hal Finney was an early Bitcoin participant. Satoshi Nakamoto's system drew upon ideas from this broader history. Bitcoin did not emerge from nowhere. It was the product of decades of experiments. Most of those experiments failed, and that makes Bitcoin's survival more remarkable, because innovation usually looks inevitable only after it succeeds. Before success, it looks ridiculous. The first automobiles were slower and less reliable than horses. Early airplanes were dangerous. The internet initially seemed like a strange academic network. Bitcoin had the same problem. Why would anyone need internet money? Banks already existed. Credit cards already existed. Online payments already existed. What problem was Bitcoin solving? For most people, the answer was not obvious, until they looked at the monetary system itself. Then the question changed. Bitcoin wasn't trying to replace your debit card. It was trying to create an asset with a different monetary structure, and that distinction matters, because one of the biggest misunderstandings about Bitcoin is the idea that its main purpose is everyday spending. Ammos's framework places much greater emphasis on Bitcoin as a form of savings technology, a scarce monetary asset, something people might hold for the long term. That idea leads to another controversial concept: digital gold. The comparison is imperfect. Gold has thousands of years of history. Bitcoin has existed for only a small fraction of one human lifetime. Gold has physical properties. Bitcoin is information. Gold doesn't require electricity to remain gold. Bitcoin depends on a functioning digital network, and gold has survived wars, governments, technological changes, and civilizations. Bitcoin hasn't had enough time to prove anything comparable. So why compare them? Because both can be understood as scarce monetary assets. And this is where the story becomes personal. Imagine you spend 10 years building a savings account. You deny yourself certain luxuries. You work overtime. You save. You invest carefully. You make sacrifices as the account grows. But then a period of high inflation arrives. Your nominal balance still rises. Yet the things you wanted to buy become much more expensive. You haven't necessarily become poorer in absolute terms, but your purchasing power may have fallen. Now imagine a different problem. You live in a country where banks are unreliable. Capital controls prevent you from moving money abroad. Your currency is collapsing. Your government restricts withdrawals. Suddenly, the ability to hold wealth outside the domestic banking system becomes extremely important. This is where Bitcoin's most powerful real-world use cases appear, not necessarily in wealthy countries with stable institutions, but in places where trust is fragile. Countries experiencing severe monetary instability have provided some of the strongest examples of demand for alternative stores of value. People have turned to dollars, gold, foreign bank accounts, cryptocurrencies, and Bitcoin. The choice isn't always ideological. Sometimes it is survival. This is why global finance cannot be understood only through the eyes of someone living in a wealthy, stable economy. For a person in New York, Bitcoin can look like a speculative investment. For someone living under capital controls, it can look like financial mobility. For someone fleeing a crisis, a seed phrase can represent something remarkably powerful. A small sequence of words can potentially allow access to wealth without carrying a suitcase of cash. That doesn't make Bitcoin risk-free. It makes the problem it addresses very real. And yet, even here, there is a catch. If you lose the private keys, you can lose access. If someone steals them, they may be able to steal your Bitcoin. If you make a mistake, there may be no bank manager to reverse it. Bitcoin removes certain forms of dependence, but it also removes certain forms of protection. That trade-off is easy to overlook. The traditional financial system often feels frustrating because institutions can control your money. Bitcoin can feel liberating because you can control your own keys. But self-custody means responsibility. There is no customer service number for forgetting your password. There is no central office that can simply restore your balance. Freedom and responsibility arrive together, and that is a theme hiding beneath almost every chapter of the Bitcoin story. More control means more responsibility. More rules mean less discretion. More independence means less institutional protection. There is no perfect monetary system. There are only trade-offs. And perhaps that is why the debate around Bitcoin became so emotionally intense. People weren't arguing about a piece of software. They were arguing about what kind of financial world they wanted. One side saw a technological breakthrough. Another saw a speculative bubble. One saw freedom. Another saw unnecessary risk. One saw digital gold. Another saw an asset with no intrinsic cash flow. One saw protection against monetary debasement. Another saw a dangerous distraction from productive investment. And both sides had legitimate questions. But beneath all those arguments was something neither side could escape: the human desire for certainty. We want to know that our savings will matter tomorrow. We want to know that our work today can improve our future. We want systems we can trust. And when institutions fail to provide that confidence, people search for alternatives. Sometimes those alternatives are dangerous. Sometimes they are transformative, and sometimes they are both. Bitcoin's greatest experiment was therefore not technological, it was social. Could millions of strangers coordinate around a monetary system without a central issuer? Could scarcity exist without a physical object? Could trust emerge from code? And could a network created by an anonymous person survive the world's most powerful institutions? For years, those questions were theoretical. Then the market began answering. Bitcoin survived its first crash. Then another. Exchanges failed. Companies disappeared. Governments issued warnings. Critics declared it dead. Yet the network continued producing blocks. Every roughly 10 minutes, another block appeared. Another piece of history was added. Another reminder that the system was still running. No press conference required. No CEO needed to reassure investors. No central bank needed to announce that Bitcoin would continue tomorrow. The network simply continued. And perhaps that was the strangest part. The experiment didn't need everyone to believe in it. It only needed enough people to keep participating. Because money has always been a network phenomenon. A dollar is useful because others accept it. Gold became money because societies repeatedly recognized its usefulness. Bitcoin follows the same basic human principle. Value grows when coordination grows, but coordination can break. And that raises the next question. What happens when a monetary network becomes so valuable that governments, corporations, banks, and professional investors can no longer ignore it? Because eventually, Bitcoin stopped being an experiment conducted on the internet. It became something much harder to dismiss. It became an economic force. And once money becomes an economic force, someone always wants to control it. At first, governments largely ignored Bitcoin. Then they noticed it. Then they warned people about it. Then some tried to restrict it. And eventually, some governments began buying it. That progression tells us something important. Institutions rarely take a new technology seriously when it is small. They take it seriously when people begin using it without them. That is exactly what happened with Bitcoin. The strange internet experiment had become a global financial network. But now came a much harder test. Could Bitcoin survive contact with the real world? Because writing code is one thing. Building an alternative monetary system is something else entirely. Consider the problem of trust. If your bank fails, you may have legal protections. If your brokerage fails, regulators may intervene. If your credit card is stolen, you can often reverse transactions. Bitcoin offers very different guarantees. The protocol protects the network. It does not protect you from yourself. That distinction became painfully clear as early Bitcoin users learned how unforgiving digital ownership could be. One of the most famous stories involves a programmer named James Howells. In 2013, Howells reported that he had accidentally discarded a hard drive containing the private keys to a large Bitcoin holding. The coins had become enormously valuable. The story turned into a years-long attempt to recover the drive from a landfill in Wales. The exact value of the lost coins fluctuated with Bitcoin's price. But the lesson remained constant. With Bitcoin, possession can become responsibility. There is no bank vault waiting behind the scenes. There is no central administrator holding a master key. The same feature that makes Bitcoin resistant to censorship can make mistakes permanent. This is one of the paradoxes of financial freedom. The more responsibility you take, the fewer people remain responsible for your mistakes. And this is where the book's philosophy becomes practical. You don't need to become a Bitcoin maximalist. You don't even need to own Bitcoin. But you should understand the principle. Every financial system has risks. The question is where those risks live. With traditional banking, some risks are institutional. With self-custody, some risks become personal. With stocks, you face business risk. With bonds, you face interest rate and credit risk. With real estate, you face leverage, maintenance, taxes, and liquidity risk. With cash, you face inflation risk. There is no asset without risk. There are only different risks. That realization changes how intelligent investors think. They stop asking, what is the safest investment? They start asking, which risks am I actually taking? That is a much better question, and it takes us to one of the biggest misunderstandings about Bitcoin. People often talk about Bitcoin as if its future price is the central issue. But price is only the visible layer. The deeper experiment is about monetary properties, scarcity, portability, divisibility, durability, verifiability, and resistance to arbitrary supply changes. Traditional money performs some of these functions extremely well. A dollar is highly portable. It is divisible. It is widely accepted. It is easy to price goods in. Bitcoin performs other functions differently. It is globally transferable. Its supply is constrained by protocol rules. Ownership can be verified cryptographically. Transactions can occur without asking a traditional bank for permission. But Bitcoin still has weaknesses. Its price can be extremely volatile. Its transaction infrastructure has evolved but remains different from traditional payment systems. Its energy consumption creates legitimate environmental and policy debates. Governments can regulate exchanges and on-ramps, and its long-term monetary role remains uncertain. These aren't footnotes. They are central to understanding the experiment honestly. A documentary about Bitcoin that ignores its weaknesses is propaganda. A documentary that ignores its strengths is equally incomplete. The fascinating story sits between those extremes, because Bitcoin forces us to ask what we actually want money to do. Suppose you are 25. You earn your first serious salary. You have no children, no mortgage, no major obligations. You can take risks. You can invest aggressively. Now imagine you're 65. Your income is limited. Your retirement depends heavily on your savings. A 50% drawdown means something completely different. Same asset, different person, different risk. This is where another behavioral bias enters the story. Loss aversion. Humans generally experience losses more intensely than equivalent gains. Losing $10,000 does not feel like the emotional opposite of gaining $10,000. The loss can feel much worse. That matters enormously in volatile markets. During a bull market, Bitcoin can make investors feel brilliant. They see prices rising, friends are buying, news coverage becomes euphoric. Social media fills with success stories. The brain begins creating a dangerous narrative. I understand this. I found something early. I should buy more. Then the market turns. Bitcoin falls 20%, then 30, then 50. Suddenly the same person who felt like a genius begins questioning everything. This is where many investors make their worst decisions. They buy based on excitement, then sell based on fear. The market doesn't need to defeat them. Their own emotions do the work. The same pattern appears in stocks, real estate, commodities, and almost every speculative market. Bitcoin simply makes the lesson more visible because the swings can be extreme. This is why one of the most important lessons from the Bitcoin standard is not buy Bitcoin. It is something more fundamental. Understand your time horizon. If you need the money next month, volatility matters enormously. If you are investing for 20 years, short-term volatility may matter much less. But even a 20-year investor needs discipline, because the hardest part of investing isn't identifying an asset. It is staying rational while everyone around you becomes emotional. This is where Warren Buffett's philosophy becomes relevant again. Buffett has often emphasized temperament over intelligence. You don't need to predict every market move. You need the emotional discipline to avoid making terrible decisions. Bitcoin provides perhaps one of the strongest tests of that discipline, because its price history can turn confidence into panic within days. And panic is expensive. Consider what happens during a crash. An investor buys Bitcoin at $60,000. It falls to $40,000. They tell themselves they are investing for the long term. Then it reaches $30,000. Fear grows. At $20,000, they cannot sleep. They sell. Months or years later, the market recovers. Now they face a second emotional problem and they feel regret. They watch Bitcoin rise again. Eventually, they buy back at a higher price. The cycle repeats. This isn't a Bitcoin problem, it's a human problem. And once you understand that, the practical lesson becomes obvious. Never invest money you cannot emotionally afford to see fluctuate. Build an emergency fund first. Control expensive debt. Diversify. Understand what you own. And create rules before emotions arrive. Because once fear takes over, your brain becomes a terrible financial advisor. There is another lesson hidden here. The difference between conviction and confirmation bias. Conviction means you have considered opposing evidence and still believe your position makes sense. Confirmation bias means you search primarily for information that makes you feel right. The internet makes confirmation bias incredibly easy. If you believe Bitcoin will reach $1 million, you can find thousands of videos explaining why. If you believe Bitcoin is worthless, you can find thousands explaining why it will collapse. Both sides can live inside separate information universes, and algorithms will happily feed both. This is why financial education requires intellectual humility. The smartest investor in the room isn't necessarily the person with the strongest opinion. It may be the person most willing to say, "I could be wrong." That sentence protects wealth, because uncertainty is permanent. And Bitcoin is perhaps the purest example. Now consider another idea central to Ammous's argument: the difference between money and credit. This distinction is easy to miss. When a bank gives you a loan, new purchasing power can enter the economy through credit creation. Credit can be extremely useful. It allows businesses to expand before they have accumulated enough cash. It allows families to buy homes. It allows companies to invest. Modern economies depend heavily on credit, but credit also creates obligations. Someone's debt is someone else's asset. If too much debt accumulates, the system becomes fragile. And when confidence disappears, refinancing becomes difficult. That is why financial crises can spread so quickly. The problem isn't simply that people owe money. The problem is that the entire system becomes interconnected. One person's inability to pay can become another person's inability to receive. A bank's losses can become a customer's problem. A company's bankruptcy can become a worker's unemployment. A housing crash can become a banking crisis. The financial system becomes a web, and the larger the web becomes, the more interconnected the risks. Bitcoin takes a radically different approach. The protocol does not require Bitcoin itself to have a central issuer creating loans against it. Bitcoin can exist without a central bank. But that doesn't mean Bitcoin eliminates credit. People can still borrow against Bitcoin. Companies can still create financial products around it. Exchanges can still become leveraged. Humans will always find ways to borrow. The technology doesn't remove human behavior. It simply changes the underlying asset. And that brings us to a critical lesson. Technology cannot repeal human nature. Give people a scarce asset. Some will save it. Give them leverage. Some will overborrow. Give them easy access to markets. Some will gamble. Give them a bull market. Some will become overconfident. Bitcoin doesn't eliminate greed. It exposes it. And perhaps that is why its history is so psychologically fascinating. The technology may be new. The emotions are ancient. Fear, greed, hope, envy, regret, overconfidence. These existed long before blockchain. They will exist long after it. So when Ammous talks about sound money, the idea isn't only technical. It connects to a much older human question. What kind of environment helps people make better long-term decisions? There is no universal answer, but history gives us clues. When people trust that savings will retain value, they have stronger incentives to accumulate capital. Capital then funds businesses. Businesses create goods. Workers produce services. Innovation increases productivity, and productivity raises living standards. This is why capital formation matters. A society cannot consume its way into prosperity forever. At some point, someone has to build a factory, a power plant, a computer, a software company, a road, a hospital, a research laboratory. Investment requires sacrifice. Someone has to postpone consumption. That is saving. And saving becomes investment when those resources are directed toward productive activity. This is where one criticism of the Bitcoin thesis becomes important. If everyone simply holds Bitcoin and waits for it to appreciate, society does not automatically become richer. Bitcoin doesn't build factories. People do. Bitcoin doesn't invent medicines. Scientists do. Bitcoin doesn't educate children. Teachers and families do. Bitcoin can potentially serve as a savings asset, but savings alone aren't enough. Wealth ultimately comes from productive human activity. That distinction protects investors from a dangerous misunderstanding. Money isn't wealth. Money is a claim, a medium, or a coordination tool. Real wealth consists of things people actually value: food, energy, shelter, technology, knowledge, infrastructure, skills, businesses, and human relationships. If every person on Earth suddenly received twice as much money, Humanity would not instantly become twice as wealthy. There would still be the same number of houses, the same amount of farmland, the same number of doctors, the same factories, the same energy resources. Money can move claims around. It cannot manufacture real resources out of nothing. This sounds obvious, yet financial markets can make people forget it. During bubbles, numbers become hypnotic. A stock rises, a cryptocurrency rises, a property rises. People feel richer. Then prices collapse, and the illusion disappears. This is why the deepest financial lesson may be surprisingly simple. Focus on what produces value, not merely what changes price. That principle connects Bitcoin to the broader world of investing. A productive business can compound value. A scarce asset can preserve purchasing power. A useful technology can transform an industry. A skilled person can increase their earning power. Your own human capital may be the most important asset you ever own, and that changes how you should think about money. Suppose you have $5,000. You could spend it on something that gives you temporary pleasure. Or you could invest in a skill that increases your income for decades. The second decision may not look exciting, but compounding works there too. A $5,000 investment in education that raises your income by $500 a month can become enormously valuable. This is the kind of thinking that separates wealth building from wealth chasing. Wealth chasing asks, what can make me rich quickly? Wealth building asks, what can become more valuable over time? That distinction is enormous, and it brings us to perhaps the most misunderstood phrase in the Bitcoin world. Number go up. The phrase became a joke, but behind the joke is a serious psychological temptation. People don't always want monetary freedom. Sometimes they simply want an asset that rises. That is speculation. There is nothing inherently immoral about speculation. Markets need speculators. They provide liquidity. They take risks. They help discover prices. But speculation becomes dangerous when investors confuse a rising price with a sound thesis. Bitcoin can rise because adoption increases. It can rise because monetary conditions change. It can rise because institutional demand increases. It can rise because people expect it to rise. And that last reason can become circular. Prices rise. People become excited. More people buy. Prices rise further. More excitement follows. Until eventually someone asks a simple question. Who is left to buy? That is how bubbles can form. Bitcoin has experienced several episodes resembling speculative bubbles. And the lesson isn't that Bitcoin is therefore worthless. It is that powerful technology can still become the object of irrational speculation. The internet did. Railroads did. Real estate did. Tulips famously did. Humans can turn almost anything into a story about getting rich, and stories move markets. This is where Bitcoin's greatest strength can also become its greatest weakness. Its story is incredibly powerful. Digital scarcity, financial sovereignty, decentralization, a fixed supply, freedom from monetary authorities. These ideas resonate emotionally, but emotional resonance isn't proof. A good investor separates the story from the evidence. What problem does the asset solve? How large is that problem? How durable is the demand? What risks could destroy the thesis? What assumptions are already priced in? And what would prove you wrong? These questions are useful, far beyond Bitcoin. They can improve the way you analyze any investment. And perhaps this is where the book's deepest value lies. Not in predicting Bitcoin's price, but in forcing readers to question assumptions they normally never examine. Where does money come from? Why do we trust it? Why do governments manage it? Why does inflation happen? Why do people save? Why do people borrow? Why do markets crash? Why do we panic at exactly the wrong time? And why do humans repeatedly trade long-term wealth for short-term comfort? These questions existed before Bitcoin. Bitcoin simply put them under a brighter light. But the world was changing again, because the same decade that brought Bitcoin also brought something else. A generation that grew up entirely online. People who already understood digital ownership, digital identity, digital communities, digital currencies inside games, digital marketplaces. For younger generations, the idea that something valuable must be physical began to feel increasingly strange. A song became a file. A photograph became a file. A conversation became a message. A bank account became numbers on a screen. So perhaps the next step was inevitable. Maybe money itself could become native to the internet. But if that was true, then one final question remained. Who would control it? Because the history of money had repeatedly followed the same pattern. A monetary system begins decentralized. A powerful institution discovers it. The institution standardizes it. Then control concentrates. And eventually, concentration creates new vulnerabilities. Bitcoin attempted to break that pattern, but whether it succeeded was still an open question. And as Bitcoin moved from the margins into the financial mainstream, the experiment entered its most dangerous phase. Because being ignored is easy. Being attacked is harder. But being accepted may be harder still. When powerful institutions begin adopting the thing they once dismissed, something subtle happens. The rebellion starts entering the system it wanted to replace. Bitcoin had spent years challenging Wall Street. Now Wall Street was preparing to sell Bitcoin, and that changed the question completely. The battle was no longer about whether Bitcoin could survive outside the financial system. It was about what would happen when the financial system came looking for Bitcoin. And eventually, it did. For years, traditional finance treated Bitcoin as an oddity, a curiosity, a speculative toy for internet enthusiasts. Then the institutions arrived. Investment firms began exploring custody. Public companies began adding Bitcoin to their balance sheets. Futures markets developed, and in January 2024, the U.S. Securities and Exchange Commission approved the listing and trading of spot Bitcoin exchange-traded products in the United States. The irony was almost perfect. Bitcoin had been designed partly as an alternative to traditional financial intermediaries. Now, traditional financial intermediaries were packaging Bitcoin into products for ordinary investors. The system wasn't simply rejecting Bitcoin anymore. It was absorbing it, and that created a fascinating contradiction. If Bitcoin enters the traditional financial system, does that make it more legitimate, or does it defeat the original purpose? The answer depends on what you think Bitcoin is for. If Bitcoin is primarily an investment asset, institutional adoption may be a major development. If Bitcoin is primarily a parallel monetary system, institutionalization raises a much more complicated question. Can an alternative system remain alternative after becoming mainstream? History has seen this before. Technologies often begin as rebellions. Then businesses monetize them. Then governments regulate them. Then they become infrastructure. The internet itself followed a similar path. It began as a decentralized network connecting researchers and institutions. Eventually, enormous corporations were built on top of it. The network became both more powerful and more centralized in certain layers. Bitcoin could face a similar tension. The protocol can remain decentralized while the surrounding financial infrastructure becomes concentrated. That distinction is critical. The blockchain can be decentralized. The exchanges may not be. The protocol can have a fixed supply. A lending platform can still create leverage. Bitcoin can be self-custodied. A user can still choose to leave it on an exchange. Technology creates possibilities. Humans create institutions around those possibilities, and institutions develop incentives of their own. That is why the future of Bitcoin cannot be understood simply by looking at its code. You also have to watch the people, the corporations, the governments, the investors, and the millions of ordinary users deciding what Bitcoin means to them. But before we look forward, we need to look backward one more time, because there is another monetary lesson hiding in plain sight: gold. For centuries, gold was difficult to produce. That scarcity gave it monetary power. But gold had a weakness. Moving large amounts of physical gold is inconvenient. Protecting it is expensive. Verifying it can take time. And storing it requires infrastructure. Banks solved part of the problem. They created paper claims representing gold stored elsewhere. Suddenly, people could trade claims instead of moving the metal itself. That was efficient. But something important had changed. The physical asset and the financial claim were no longer the same thing. You might own a claim to gold without personally holding the gold. This created a new layer of trust. You had to trust the institution holding the metal. That pattern eventually expanded. Modern money became increasingly based on claims, bank deposits, loans, government bonds, financial derivatives, credit instruments. The financial system became extraordinarily sophisticated, and sophistication created efficiency, but it also created complexity. When the system works, complexity can be invisible. When it fails, complexity becomes terrifying. The 2008 crisis demonstrated this brutally. Millions of people didn't understand mortgage-backed securities. They didn't need to. They trusted the financial institutions using them. Then the system became unstable. The lesson wasn't that financial complexity is always bad. It was that complexity can hide risk. Bitcoin took a radically different approach. The core monetary rules are comparatively simple. There is a public ledger. Transactions are verified. Blocks are produced through proof of work. The supply schedule is predetermined. The maximum supply is capped at 21 million. The system is transparent, but simplicity at the protocol level doesn't guarantee simplicity for users. Around Bitcoin grew an enormous financial ecosystem: exchanges, custodians, lending platforms, derivatives, funds, payment companies, mining companies, wallet providers. And with every additional layer came additional risks. This creates an important practical lesson. Bitcoin may be decentralized, but your Bitcoin experience might not be. If you hold your coins through a third party, you are still trusting someone. And that leads to one of the oldest lessons in finance. Don't confuse an asset with the institution holding it. A gold bar in your possession is different from a promise that someone has gold. A stock held directly through a regulated brokerage is different from an unregulated claim. Bitcoin held in your own wallet is different from an exchange balance. The technology may be trust minimized. The surrounding system may not be. And that distinction became painfully obvious through the collapse of major crypto companies. The most famous example was FTX. In November 2022, FTX filed for bankruptcy after a liquidity crisis and revelations surrounding its relationship with Alameda Research. Customers discovered that the assumption underlying their balances was not the same as actually controlling the underlying assets. The collapse became one of the most important lessons in crypto, not because Bitcoin itself had failed, but because a company had. That distinction matters. If you keep your money with a bank, you are trusting the bank. If you keep your Bitcoin with an exchange, you are trusting the exchange. The blockchain cannot protect you from a dishonest intermediary. And suddenly, an old Bitcoin phrase made sense. Not your keys, not your coins. The phrase is simple. Its meaning is profound. Control is different from ownership on paper, and that brings us back to the philosophy behind the Bitcoin standard. Ammous argues that monetary systems should reward long-term thinking, but long-term thinking requires something else: responsibility. You can't build a future while constantly outsourcing every decision. At some point, you have to understand what you own, where it is held, what risks it carries, and why you own it. This is true even if you never buy Bitcoin. Suppose you own an index fund. Do you know what it contains? Suppose you have a retirement account. Do you understand the fees? Suppose you own a house. Do you know how much leverage you're carrying? Suppose you have a savings account. Do you understand the effect inflation can have over 20 years? Financial independence begins with understanding, not with prediction. And this is where the book's historical approach becomes surprisingly useful. History teaches us that monetary systems change. The currencies people once considered permanent eventually disappeared. The Roman denarius changed. Medieval monetary systems changed. Silver standards changed. Gold standards changed. The Bretton Woods system changed. And today's monetary system will eventually change too. That doesn't mean the dollar is about to collapse. It doesn't mean Bitcoin will replace it. It means permanence should never be assumed. The future is uncertain. The best response isn't panic, it is preparation. This is where diversification becomes essential. A person who puts everything into one asset is making a concentrated bet. That asset might be Bitcoin, it might be gold. It might be real estate, it might be one company's stock, it might even be cash. Cash feels safe because the number doesn't move. But inflation means its purchasing power can change. So diversification isn't simply about owning many things. It is about owning assets with different risks. A productive business can generate earnings. Bonds can generate interest. Cash provides liquidity. Real estate can provide shelter and potential income. Gold provides a physical scarce asset. Bitcoin provides a digital scarce asset. Each has strengths, each has weaknesses. The goal is not to find the magical asset that eliminates uncertainty. There isn't one. The goal is to build a financial structure that can survive uncertainty. That is a very different mindset. And it leads to another question. How much Bitcoin should someone own? There is no universal answer. For one person, 0 may be appropriate. For another, a small allocation may make sense. For someone with enormous conviction and high risk tolerance, the allocation might be much larger. But the crucial principle is position sizing. You don't need to be certain to invest. You need to make sure that being wrong doesn't destroy you. This is one of the most powerful principles in risk management. Survival comes first. If an investment can make you rich but can also permanently destroy your financial life, the size of the bet matters enormously. Professional investors think about this constantly. They don't simply ask how much they can make, they ask how much they can lose, and they ask whether they can recover. Because a 50% loss requires a 100% gain just to return to the starting point. A 90% loss requires a 900% gain. Mathematics can be brutal, but human psychology is even worse. After a large loss, people often become desperate. They chase higher returns. They take bigger risks. They try to recover quickly. That can turn one mistake into a catastrophe. So the first practical lesson from the Bitcoin story isn't buying anything. It is building a financial foundation. Keep emergency savings. Control high-interest debt. Protect against catastrophic risks. Increase your earning ability. Invest consistently. Then experiment with higher-risk assets, only with money you can genuinely afford to lose. This sounds less exciting than predicting Bitcoin's next price. But boring financial habits create extraordinary outcomes. The person who saves every month for 20 years often beats the person who constantly searches for the next big opportunity. Why? Compounding. And compounding is another place where Bitcoin and traditional investing intersect. Suppose you invest $500 every month. You don't need to find the perfect entry point. You don't need to predict every crash. You simply keep contributing. Over decades, the combination of contributions and returns can become powerful. The hardest part isn't mathematical, it's behavioral. You must continue when markets are boring, continue when markets are frightening, continue when everyone else is celebrating, and continue when nobody cares. This is why patience is an investment advantage. Markets transfer wealth from impatient people to patient people surprisingly often. But Bitcoin adds another psychological challenge. It can make patience feel impossible. When prices move dramatically, your brain starts telling stories. Maybe I should sell. Maybe I should buy more. Maybe this is the beginning of the end. Maybe this is the opportunity of a lifetime. Maybe everyone else knows something I don't. These thoughts feel urgent. Most aren't. A useful investing rule is to create decision rules before you need them. For example, I will not invest money needed within 5 years. I will not borrow money to speculate. I will rebalance rather than chase whatever is rising. I will research an asset before buying it. I will define what would make my thesis wrong. These rules create a barrier between emotion and action. That barrier can protect wealth. And this is where behavioral economics becomes incredibly relevant. Humans aren't perfectly rational calculators. We use shortcuts. We follow crowds. We fear losses. We become overconfident after success. We underestimate rare risks. We anchor on previous prices. We confuse familiarity with safety. Bitcoin triggers almost every one of these biases. That makes it dangerous, but it also makes it educational. It is like a financial stress test for the human brain. Consider anchoring. Bitcoin reaches $100,000. You decide it is expensive. Then it falls to $70,000. Suddenly, $70,000 feels cheap. But why? Because your brain anchored to $100,000. The asset isn't necessarily cheap. It is simply lower than the number you remember. Now, reverse the situation. Bitcoin falls from $100,000 to $40,000. People start calling it a bargain. But the previous price doesn't tell you what the correct price should be. A falling price isn't automatically an opportunity. Sometimes it is information. Sometimes the underlying thesis has changed. The same principle applies to stocks. A stock falling 50% might be a bargain, or it might be a business deteriorating rapidly. Price alone cannot answer the question. You need a thesis. That is why intelligent investors separate price movement from fundamental reasoning. And Bitcoin makes this distinction especially difficult because there are no traditional earnings to analyze. You have to think in terms of network adoption, monetary properties, competition, regulation, security, liquidity, macroeconomic conditions, and user demand. That is a much more uncertain exercise, which is why humility matters. Nobody knows Bitcoin's future, not the critics, not the maximalists, not the influencers, not the analysts, not the billionaires, not the person confidently predicting $1 million, and not the person confidently predicting zero. The honest answer is uncertainty. The question is what you do with it. This is perhaps the most important lesson from the entire Bitcoin experiment. You don't need certainty to make a good decision. You need a decision that remains survivable if you're wrong. That principle works everywhere. Business, investing, career, personal finance, life. Now consider what Bitcoin has already changed, regardless of what happens to its price. It changed the conversation about money. It forced central banks and governments to confront digital assets. It accelerated development in cryptography and decentralized finance. It demonstrated that a global network could maintain a scarce digital asset without a central issuer. It created an entirely new industry, and it gave millions of people a reason to learn how money actually works. That alone is significant. Before Bitcoin, most people rarely asked why money has value. They simply used it. Bitcoin forced the question into public conversation. What makes something money? Is it government backing, physical scarcity, social consensus, network effects, utility, history, all of the above? There is no single simple answer. Money is partly a social technology. Humans agree that something can represent value. The agreement becomes powerful when enough people participate. And that means money is ultimately about coordination, which takes us back to the opening scene. The person sitting alone at the desk, the city waking outside, the paycheck, the savings, the prices, the quiet erosion that nobody notices until years have passed. The deeper lesson isn't that one currency is good and another is evil. It is that money deserves attention, because money is not just what you spend. It is stored time. It represents hours you worked, opportunities you gave up, decisions you made, risks you took, and dreams you postponed. When you understand that, saving becomes more than accumulating numbers. It becomes protecting your future choices. And perhaps that is why the Bitcoin debate became so much larger than Bitcoin. It forced people to confront an uncomfortable reality. Your financial future depends partly on systems you don't control. But your response to that reality is still within your control. You can learn, you can save, you can invest, you can diversify, you can reduce unnecessary debt, you can protect your downside, you can build skills, you can avoid emotional decisions, and you can choose what risks you are willing to accept. That is financial sovereignty in its most practical form, not owning a particular asset, but understanding the consequences of your choices. And there is one final idea we haven't fully confronted. The idea that perhaps the most valuable thing Bitcoin offers isn't a new way to spend money, or even a new way to invest. It may be a new way to think about time, because once you begin questioning money, you eventually begin questioning what money is supposed to do. Is money meant to make you richer today, or protect your ability to live well tomorrow? Is investing about becoming wealthy quickly, or converting today's labor into future freedom? Is the goal to maximize returns, or to maximize the number of choices you will have later? Those questions sound financial. They aren't. They are questions about life, and that is where the story of Bitcoin becomes much bigger than a cryptocurrency, because every generation inherits a monetary system. Every generation assumes it will last. Every generation discovers that it changes. The only real question is whether we understand the system well enough to adapt. And perhaps the strangest thing about Satoshi Nakamoto's invention is that it never needed to answer that question for us. Bitcoin simply placed a new option on the table. Then it stepped back. The network kept running, block after block, year after year. While governments debated, markets crashed, companies disappeared, investors panicked, new fortunes were created, old fortunes vanished. And through all of it, the underlying question remained: can humans build a form of money whose rules are stronger than the people using it? We still don't know the final answer. But after more than a decade of Bitcoin surviving attacks, crashes, scandals, regulatory battles, technological changes, and extraordinary speculation, one thing has become impossible to deny. The experiment was real, and the world was paying attention. Which brings us to the question that matters most: not whether Bitcoin will replace the dollar, not whether its price will reach some magical number, not whether you should buy it tomorrow. The real question is much closer to home. What are you doing with the money you already have? Because if money represents your time, then every financial decision is also a decision about your life. And once you understand that, the lessons of the Bitcoin standard begin to reach far beyond Bitcoin itself.